Good afternoon, everyone. It's Mortgage Rob here, your mortgage broker serving Cloverdale, Langley, and the Fraser Valley. Wanted to talk to you a little about a really common question that I'm getting these days from many clients, potential clients, and past clients, and it kind of goes hand in hand with the news headlines that we're seeing today, talking about potential drops in many real estate markets across the country. There's a lot of predictions on what sales might be in the upcoming 12 months or so. Some talk, there was talk about housing crashes, which is unlikely, but kind of like a balloon and some air being let out of it. So we're seeing a lot of conflicting reports about whether real estate prices are going to be dropping, whether the markets are going to be slowing. So we're maybe not sure what to expect. Personally, I think it's going to be a little bit quieter next year. But that leads to a question of a lot of clients have in their minds is whether they should take action today on their real estate plans, or whether they should wait maybe 3 months, 6 months, 12 months, or even longer to see what markets are going to do. So it's a little bit different depending on whether you're looking at a principal residence, whether you're looking at an investment property, but sort of the same principal rules apply. One thing that does get missed in many of the cases is that it's okay to look at, timing the real estate market, but one of the things that you might be missing is at the same time you're also missing out on these historically low interest rates that we have today. And there's a cost to that. So while you are looking at the market and you're saying, gee, if I got a 5% drop on this piece of property that I'm interested in, boy, it's going to save me, if it's a $500,000 property, it might save you $25,000. But if at the same time while you're waiting for that price to drop, you see interest rates increase, then you may just wash out basically what your savings are. So it's a very interesting thing to consider, is that you can't isolate just one factor, as most of you know, in purchasing real estate, that you have to look at two factors. I'm going to put a little report up on a screen here, and it gives you an example of a $500,000 property. In this property, it gives you a side-by-side comparison of whether or not you should wait 12 months or 24 months to purchase or to buy this piece of property, and then it also makes some assumptions about the interest rates that might apply. So as you can see, in each case, after 12 months, you may save $25,000 in the price, but because of a potentially higher interest rate of, say, 1% 12 months from now, you actually end up being a little bit further behind. What you gained in the reduction in price of the property, you actually lost in the cost of the mortgage. And in 24 months, even if a 10% drop in 24 months, because interest rates you are expecting in the future to be higher, again, you end up being further behind. So the case of whether to buy now or buy later is not as simple as you might think. That while in the next few months, if you're to hang on, you might benefit still from some low interest rates, but at some point we're going to see interest rates climb, and what you don't want to get caught is waiting for that property to come around that you're waiting to decrease, and then all of a sudden interest rates are higher. So this is just a very simple report that if you have questions about this, I'm happy to help. You can always give me a call at 778-686-8326 or through my website, mortgagerob.ca. Be happy to run some numbers for you and help you with your decision. If you have any questions, don't hesitate to call. Take care.